Hi, this is Matt from Synergy for Trading. Today we're going to discuss why squiggly lines are evil and they're costing you money. Okay? At Synergy for Trading, what we do is we teach price action. Price action is the study. It's almost like candlestick analysis. In some ways, it is candlestick analysis, and we teach how to use up to the tick information to judge entries and exits in any market in any time frame that you want to trade. Um, the advantages of this are you don't have lagging information. Think about this for a second. Every indicator that you can possibly imagine, be it a moving average, a MACD, everything is lagging. Why is everything lagging? Because price is an input to the calculations for that indicator. So by definition, every indicator is a lagging indicator. Most people know this, okay, and they just kind of accept this as just like one of the truths of trading, that you just have to deal with it and put up with it. No, you don't. And I'm here to tell you most professionals don't, okay? If you think a professional, or at least most of them, sit on Wall Street and they look at a MACD oscillator to make millions of dollars each day. No, they don't. So why don't they do that? They don't do it because it's not up to the second information. So that means somebody else already has the information before they do. And that's not how you get there. That's not how you make money. So what we're going to show and illustrate here is just, this is a simple recent signal we had on the Euro JPY earlier this morning. I don't know that I would be up personally trading at 434, but dragging back through the chart this morning, this was the first one that I saw. This is a nice little pin bar long. You can see our software identifies this as a pin bar long setup. And we would be looking for this setup at this point in the chart. We explain all of this in our trading course. But the advantage to price action is at the close of this bar at 4:34 in the morning, we are looking to get long in this market. Okay? Now, how we advocate trading at Synergy for Trading is we'd try and buy, we'd wait for a move up above this level. So we'd buy long into here around this price at 130.11. Let's say we get filled 130.12, something like that. 130, in that area. For math purposes, let's ignore the spread for just the time being to illustrate the difference in your entry prices. Okay. Let's say I get filled at 11. Let's say it went up and it came back down here, and it would have on this bar. So let's assume that I could have gotten filled at that price or better, because I could have. So we're long from 130.11 in the Euro JPY on this bar. Boom. We get to par at 1 to 1. This distance is 1 times that distance. Okay, so we're at par here. We target 2 or 3 to 1. Personally, I'd be looking for 3 to 1, but after I see this is another price action setup that's telling me I should probably go short. It's their synergy signal to go short. I would be exiting this position up here. So let's say I exit, and at the close of this bar, I have that information. I don't have to wait for a moving average to cross to red. So I'd be out at the close of this bar at 27 rather than waiting for a moving average to cross over and close me out for 10 pips less. Likewise, what I want to illustrate here. So this is the price action exit, okay? I'm out there. Greater than 2 to 1 on the trade. Now, this is the whole moving average. It's supposed to be a fast, smooth, adaptive moving average, and it's set to a 21 period. So it's supposed to really track price pretty well, okay? It's supposed to be pretty quick. And so when it flips to green versus red, you have a shift in bias. So let's look. For this to actually be a confirmed flip, it has to be 2 candles. So this is not your entry candle. This is actually the first candle where this would be colored green, okay? So you have to wait 2 bars. Likewise, this candle was not the first candle where this was actually painted red. It didn't get painted red until that candle closed. Okay, so you understand what I'm saying? So this is actually, if I have the exact same setup, which is a valid setup, but I'm using lagging information, even on a fast moving average to enter the market, I'm long at 27.9. Okay, what does that do? A couple things. First off, here's my new risk factor. It's 24 pips instead of 10, or I don't even know what were we risking. It's 24 pips instead of 7 pips, okay? Which means the market has to go 48 pips to get to 1-to-1 to get me to par, let alone 2 or 3-to-1 to get me out of the trade. And and as you can see, the difference is where you're getting in with the lagging information is where I'm exiting the trade with 2 or 3-to-1 terms of profit already. That's why lagging information sucks, okay? And that's why you don't want to trade it. So what is price action? Price action is up to the second information that gets you in sooner, gets you out sooner. You don't have to wait for this lag, okay? And that's how you make money in the markets. That's how the pros make money in the markets. They don't wait around for something to tell them something that happened 20 bars ago. I knew 20 bars ago that the momentum was shifting out of this market, okay? Or that it was coming into this market. I didn't need a moving average to tell me. And so that's what we teach you at Synergy for Trading, how to exploit setups identical to this, get 2 or 3 times your risk factor on every setup. And that's what we can teach you, and that's what we have to offer you at Synergy for Trading. And that's some of the benefits of price action.